Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community.
I'm Nathan Stovall, and on this episode, we're talking about the possibility of the Fed engineering a soft landing as it works to tame inflation. The prospect certainly seems harder in light of the recent liquidity issues facing the banking industry that erupted the week of March 6, most notably with the failures of Silicon Valley Bank and Signature Bank late in the week and over the weekend. Those two closures marked the second and third largest bank failures of all time in the U.S. Still, those two banks had high concentrations of large deposits and were exposed to the tech and crypto sectors. And before those bank runs occurred, the underlying economy on Main Street continued to show strength and inflation was still running hot. Joining me to talk about the prospects of a soft landing and what markets, the consumer, and companies are telling us about the economy are two of my colleagues who are senior reporters at S&P Global Market Intelligence, Peter Britton and Brian Scheid. Thanks for joining me.
Yep, thanks very much. Thank you for having us.
So let's start off, as you guys were looking at this, how likely did market watchers think that a soft landing could occur at this point in the cycle?
Yeah, so I think that the majority of the economists we spoke to, and they expect a recession. It's just a question of how severe that recession will be. Like you mentioned, a soft landing. This is where we get into soft landing versus hard landing. For a while, there was a no landing theory being floated. We just need to define really what it means. So the Federal Reserve is on this rate hike path after 2 years of near zero rates. And the response to the pandemic, they've really pushed rates up by 450 basis points over the past year. And there's a question about how much further they're going to go. Now, under a soft landing, the Fed continues to fight inflation through these higher rates. GDP slows down. GDP still grows, but it grows below trend. We just don't see this decline. With a soft landing, you have unemployment that's going to go up. We had the sort of lowest unemployment we've ever seen since the late 60s. It's going to go up, but it's not going to spike. And inflation, which this summer had hit its highest level in over 40 years, that's also going to continue to decline. So it's a recession, but it's not really a devastating one. Under a hard landing scenario, that slowdown, there'd be a slowdown in hiring, but it would be through widespread layoffs. Households would they significantly pull back spending. We'd see a big jump in credit delinquencies. We'd see business defaults. And we'd have this cycle of more layoffs, more credit stress. And I think the view from economists is that at the moment, a soft landing is still more likely than a hard landing, but a lot can change very fast. And we're seeing that with this, the ongoing collapse of Silicon Valley Bank and the other banks. Bad things can happen very quickly. And that soft landing view, that could be changing as the narrative keeps changing. When we're talking about early days of the Fed's hikes back in March 2022, a lot of talk was, the war in Ukraine. It was port congestion. Now we're talking about the stability of banks. So everything is different, almost from a day to day or hour to hour perspective.
Yeah, it's quite fluid right now, no doubt.
Yeah, I mean, I would say, certainly the MI, our economists are suggesting that they do expect there to be a shallow recession, a short, shallow recession later this year. But it's really going to be all about inflation and interest rates. The longer inflation persists, the higher interest rates will go, and then the bigger possibility of a Fed overshoot, and they squeeze the economy into recession. And that's the main thing. You've had consumer spending holding up the economy. How long can that persist? For all the things Brian has said, it can't go on forever. And if rates stay high, it means that it's going to take longer for them to come down.
No doubt about it. One of the things you mentioned rates. We often look at where rates are going, particularly the yield curve and the shape of the curve as an indicator of the potential for a recession. The curve's about as steeply inverted as we've seen in a really long time. Do we still think it's a reliable indicator, though, of a recession? Because, it would be suggesting that things are really out of whack, but this is a different cycle.
The 3-month 10-year has never gone wrong because it always gets there before there's a recession. But it doesn't determine when. There can always be a significant lag, and often the curves are reverted by the time the recession hits. But Brian's written a story about this, so he can speak much more about this than me.
Yeah, and getting into back getting back to Silicon Valley Bank again, as reported, a big part of how they failed was the fact that the longer dated yields in their treasuries and other fixed income investments, they'd lost so much ground to the shorter term yields. The yield curve or the yield curve's inversion, it's really been one of the bigger stories of the post-pandemic market and the role that central banks have had in it. It's very fluid at the moment, but the yield curve remains inverted. And over the past couple of months, key portions of the curve, let's look at like the 2 and the 10 year, they've been inverted to historic levels. We should get back to what that means though. So for our purposes, an inverted yield curve, it's important because it has preceded every recession in modern history. And everyone is questioning, does this mean this yield curve or this inversion is a flashing big warning sign that a recession is ahead? Maybe, but not necessarily. And I think a lot has to do with, the sort of the conditions we're facing coming out of this pandemic. Despite the deep inversion, stocks have rallied, labor market remains strong. The typical things you'd see in a run up to a recession, they haven't really taken place yet. And I think what we heard is that, this inversion could be different because the causes why it's inverted are so different. And this inversion follows a global pandemic. It's been pushed along by the most aggressive series of rate hikes in Fed history. I don't know if there's ever really been this much focus on what the Fed is going to do and how, in terms of how the market is focusing on it. So is there just too much noise that we can't use this as sort of a barometer, a recession barometer? Can we take the standard traditional message from the shape of the yield curve when we're living in such an unusual, non-traditional time? That's certainly something that we're watching.
We're not seeing things that would normally jibe with, call it that flashing yellow. And one of the pieces is the strength in the consumer. It's a consumer-driven economy, and we've seen consumer spending continue to hold up fairly well, I think. How have we seen the consumer hold up in the face of elevated inflation?
Yeah, I mean, the Fed's really pushing to cool the economy through higher rates. It really has not impacted consumer spending so far. Maybe not in the way that they've hoped. We saw the retail spending numbers in January really exceeded economists' expectations. You look at, the latest numbers on household debt. We had a record $16.9 trillion in the fourth quarter of 2022. That's an 8.5% jump in a year. Consumer sentiment is up. Credit card debt is up 15% in a year. Household savings rates, though, are down. If you remember in the early days of the recession, we had the government stimulus checks and everything. There was this trend we saw in the early days when Americans were spending a lot less, saving more. Their credit card, they were paying off their credit card debt. Now that's a much different. U.S. household finances right now are really moving in the wrong direction for the Fed. If you want inflation to go down, you need to curb consumer demand. You really need to slow spending. And that really hasn't happened yet. I think you see some early indicators in, mortgage rates spiking, and that has had some chilling effect in the housing market. But, looking at like the retail level, it certainly has not. A lot of people I spoke to for these stories, they think, and this is a point Fed officials have made as well, is there's this lag. It's going to take a while for the Fed's shift in monetary policy to really bleed through to the entire economy. Consumers right now at the moment, they really aren't reining in their spending yet because they haven't really felt the impact of these rate hikes yet. That could change soon, and how that hits, that could, have a lot to do with whether or not this landing is going to be soft or hard.
Well, and one of the things, too, to help them is that they accumulated so many excess savings during the pandemic, and we've seen those draw down, but, that can kind of continue to fuel spending. And another one, too, is that so many people refied their mortgage and, now have a 30-year fixed mortgage, and that's such a big portion of outstanding debt balances with a pretty low rate. So, the Fed tries to move that, put more pressure to slow down the economy. That's not changing.
And people that are in these sub 3 or 3% mortgages, these historically low mortgages that came out of, 0% rates from the Fed, those people aren't going to be moving, so that has a real serious impact on supply.
Yeah, no doubt. We've seen transaction activity slow down pretty heavily in the housing market. One other piece that is sort of going on in the background here is that the U.S. government is again flirting with default if they don't raise the debt ceiling by the summer. And this is happening at a time where the government is about as divided as it's ever been. What are we hearing from policy experts on the likelihood of reaching a deal before that they would hit a default period?
Yeah, this is something that comes around often, as you say, but this time it's a bigger question mark than there has been before. If you talk to people in the market, they think the Republicans and Democrats will knock lumps out of each other, but in the end will come to an agreement because it would just be so insane to actually make the US government default. But if you talk to a lot of political analysts, they don't really see how it can happen. I mean, you're going to have to get a divided Congress to get Democrats agreeing with Republicans. But even more than that, you're going to have to get Republicans to agree with other Republicans. I think, the fraught election of Kevin McCarthy to Speaker really highlighted the dysfunctionality that's there within government. And so at the moment, markets haven't really priced in the US government, sleepwalking into a default. But if you look at 2011, 2013, those are the two previous times when the debt ceiling was reached. And then there was a protracted period of brinkmanship between the politicians. And it wasn't really until the weeks before the D-Day, the X date is what they like to call it, where the government would have run out of funds to avoid default, that the markets really reacted. And we did see, the S&P 500 slumps in 2011. And it was right up till the very last day when Barack Obama, then president, had to climb down and allowed the Republicans to slash his budget to actually get through and avoid the default. 2013 as well, we saw Treasury yields, they climbed from 2% to 3% over the 10-year in the days coming up before there was an agreement as well. So certainly the markets could panic, but they're probably not going to do it yet. They're too busy panicking over the banking system.
But to your point, even though the deal was reached, the summer of 11 was ugly for the markets.
Right.
And markets don't like uncertainty. So it sort of feels like the closer you get, particularly at a time when even thinking of that level of volatility, we're experiencing even worse given what's going on with concerns over liquidity. If you get even somewhere close to this, as long as some of this fear persists, that does not seem like it's going to lead to very sanguine markets.
No, absolutely. I mean, if you think about what happened in 2011, even after an agreement was made, that's S&P Global Ratings still saw fit to downgrade US government debt. I mean, it's pretty remarkable that political dysfunctionality is now taken into account by the ratings agencies when it comes to the US government. But absolutely, yeah, we saw the treasuries, we saw the dollar, we saw stocks, everything reacted. And, this time it would probably be the same, but with some crypto as well.
How is that translating to sort of financing for companies in the markets? Certainly, I spend a lot of time focused on what banks are doing, and we can talk about that in a bit, but plenty of corporate America finances themselves in the capital markets. What does the access to capital look like for them right now? And what are the expectations for, call it the default rates heading into the next year?
Well, it's interesting. Obviously, companies recapitalized heavily during COVID because monetary policy was so loose. I mean, quantitative easing, yields crashed on everything, and there was record levels of bond issuance. And companies, we've been doing a lot of serious following different liquidity metrics and debt metrics, and companies have been in better shape than they were before the pandemic. It's gradually weakened as margins have been squeezed, and obviously consumer spending has been hit, and just the broader economy has been slowing. But still, if you look at the likelihood of defaults, the default rate is not expected to climb particularly high. The S&P ratings, they have a trailing 12-month default rate they expect it to be about 4% by December, which is up from about 1.7% at the end of last year. But it's not very high compared to other recessions. I think the financial crisis in 08-09, we saw a default rate of around 12%. It was similar during the time of the tech bubble. Once again, this comes down to interest rates, though. If inflation stays higher for longer and rates stay higher for longer, that means rates will take longer to come down, and it brings more and more companies into the kind of the maturity stage where they're going to have to refinance at a higher rate. At the moment, one of the things of issuing a lot of debt wasn't just getting a lot of cash on the balance sheet at a cheap rate. It was also pushing out the point where they have to start refinancing. So it's going to be 2024, 2025. companies that right now that are thinking, well, that's fine because we're going to tame inflation and rates will come down by then. If inflation stays hot, then rates are going to go higher, and there's a big lag before rates really come all the way down. So it may be that we'll have a default rate of around 4%, maybe 6%. I think S&P's worst case scenario. But it could be that kind of level just persists for a couple of years until rates come back down again.
Well, as we're looking at the tape right now, I think everybody's grateful that their next round of maturities are not right now, because the markets are not exactly that friendly in the moment. Though we did still see a large deal outside of the financial sector announced today, which sort of showing sort of that divide, that this is very specific to the financial sector and maybe some stress in the tech sector. But one other thing you guys have covered pretty well, the idea of access to capital and capital markets, but something that we're starting to wonder about is, if bank liquidity is more stretched, will they slow down on loan growth? And we've heard in providing companies access to capital, and we've heard some people question that, but if you look at the Fed numbers, lending has continued pretty steadily. So it's more of just a fear of that playing out, I think, at this point.
Yeah, and then what does this SVB collapse, what does that mean for access to capital, or even perception of access to capital going forward? Do banks then start to rein in or tighten that access, and does that then increase the possibility of a hard landing?
Well, no doubt, if there's broad deleveraging, that's not good for supporting further economic growth. And we saw coming out of the GFC that banks were so focused on delevering that it led to persistently low growth for a period of time. If the Fed's efforts to provide shore-up liquidity through their bank term lending facility actually really do it, and it is throwing, they hope, a bazooka at the market, it seems like that wouldn't necessarily happen, and that maybe the two banks that have failed, it was an idiosyncratic issue. And in fact, we had talked before we started this, the idea that JP Morgan is providing financing to one of those banks that's been hit heavily in the market in First Republic. So it seems to me, again, more fear-driven rather than anything that has played out yet.
Yeah, I mean, I do. It's a really interesting kind of mini banking crisis we're having at the moment, because when you look at, SVB, they had a very particular issue, which was that they represent the VC community pretty much solely. And, there was some panic there and money got pulled. And then because of the nature of the way they use their deposits of just investing heavily into treasuries at low yields, and then having to meet the redemptions they had to sell and then realize losses on that. That was a very specific problem to that bank. I mean, this is not going to be a big issue for the big banks, particularly now that the Fed has come out and laid out the policies that they have. So it'll be interesting to see whether this is just investor confidence, sheep following the first sheep that bolts, or if this becomes a more systemic thing.
It gets into whether or not that was this an isolated incident to this one bank, and does that perception matter? Does that perception matter that it could affect every bank? Get the Fed to sort of change course at all on its rate hike path? I mean, it's a pretty big question mark. And then we're also talking about the next inflation print coming out tomorrow morning, and that could change everything. The Fed could, we could have a hotter than expected number, and the Fed will go to 50 basis points rather than thinking about a pause. So there's a lot of open questions out there.
Yeah, and that's where I wanted to close on, what do we think they do now? Because you had 50 coming into the next meeting before last week, and then this weekend you had some people kind of bring back and go, well, maybe they won't move at all. But to your point, they've been so focused on killing inflation sort of at all costs. Do you feel like that CPI number is as much of a determinant as anything that we saw in the past week?
I don't know if they're looking at anything but CPI and the jobs report. I mean, I think that their number one mission is bringing down inflation, and it's bringing down inflation at pretty much all costs. So Chairman Powell has talked about the possibility, he gave Senate testimony last week and repeated it in the House, that the Fed could accelerate their rate hike path depending on what the data tells them. So if you have we've seen this persistently high level of inflation. It's coming down, but certainly not fast enough for the at a level the Fed would prefer. So if let's say the CPI goes up, you don't want to get into too many hypotheticals here. But if it remains persistently high, if it's problematic for the Fed, they could go forward. It's very possible they could go forward with a 50 basis point hike, even if this crisis in the banking sector continues, even if maybe it does spread to another bank. I mean, we don't know. We're also in a blackout period for the Fed as well, so there's no Fed official out here talking down or talking up what they plan to do. So I keep coming back to it, but it's everything is an open question at this point.
I think the Fed has consistently disappointed markets, and if the print comes in high, then I think they'll keep raising rates.
Well, I think that's a great place to leave it. Brian, Peter, thank you so much for coming on the show and talking about it.
No, thank you, Nathan.
Thank you very much.